Everybody, hope you are having a wonderful day. In this video I'll be comparing stocks versus ETFs to help you guys make a decision in which one is better for you to invest in. If you're new to this channel, I post videos about investing in finance, so if any of my videos help, please don't hesitate to subscribe to me for more videos like this. I do not get any financial benefits from making these videos. So let's get started, guys. What are ETFs? ETFs stand for Exchange Traded Funds. This is a type of security that involves a bag of stocks that's traded in a stock exchange. These ETFs are usually managed by an investment advisor. For these ETFs, you have to pay an expense ratio. Some ETFs pay more depending on the type of manager they have. So there's passive managers and active managers. So I'll get to that point in the next slide, but for now I'm just going to show you an example of an ETF and how it all works. We're at the Vanguard website right now. So the ETF we're going to talk about is VOO. This is the S&P 500 ETF. This tracks the whole S&P 500 market for the United States stock market, which is 500 of the largest United States companies. So there is an expense ratio of 0.03%. So that's quite low. It is managed, see, I told you guys, it's managed by an ETF advisor, so it's not just one manager, but it's a whole group. They pay a 1.5% dividend, which is always good. For one share, it's trading at 352.01 cents. So if you look, this is the returns they've gotten, it's pretty good. And this is the 10-year return. So for this ETF, there is a total of 509 stocks. So it's quite diversified. So the top 10 largest holdings are Apple, Microsoft Corp, Amazon, Alphabet, Facebook, Tesla, Berkshire Hathaway, Johnson & Johnson, JP Morgan, and Visa. So those are all large companies. So we can see the diversification to diversify in every sector. You can just go search up some ETFs that in specific sectors such as industrials, real estate. There's REITs that have ETFs, so you guys can look that up. So there's two types of ETFs. There's called a passive ETF and an active ETF. A passive ETF is an ETF that tries to replicate the broad equity market. So such as the VOO, the ETF, they track the S&P 500. They don't pick specific stocks. They pick according, so they just go to the S&P 500. The manager just picks from the S&P 500 whatever's in the S&P 500 and they put it in their own fund. So they don't pick the stocks themselves. Passive ETFs usually have a low expense ratio. Active ETFs, they are actively managed funds. We can manage by a whole group, like for Vanguard, it's managed by Vanguard, but for active ETFs, they're managed by one specific manager. An example of an active ETF is called the ARK funds, which I'll get to it. So it's by one manager, which is Catherine D. Ward, and she can sell stocks, put the stocks in the fund. Unlike the passive ETF, they just pick it from the equity index, which is different. We can see that the expense ratio is 0.75%. That is quite high. That's more higher than the VOO, which is 0.03%. Usually with these active ETFs, the expense ratio is higher because there is an actively managed manager. We can see year to date they have a better return than the VOO because they're actively managed. There is a 152.51% return on this, which is it's way more than VOO. This ETF focuses on growth stocks. So this is really risky. So we're going to move to individual stocks. Individual stock is basically purchasing ownership of a company. So basically if you buy one share of Apple, you own a piece of Apple. So that's basically individual stocks. Unlike ETFs, individual stocks are really risky because they're not diversified at all. So if Apple goes down, you lose all your capital. Whereas an ETF, if Apple goes down, you only lose a portion. I've discussed this in my last video, but I'm just reiterating this in this video. So individual stocks, they have the potential to have high risk, high reward because they're not weighted down by other stocks. The thing with individual stocks is that you manage it yourself. There is no manager to manage this stock for yourself. So you buy when you want to buy and you sell when you want to sell. It's all up to you. Okay, the next negative of individual stocks is because it's quite hard to have diversification. This is because if you have 30 individual stocks, that means you have to do a ton of research and it takes a lot of time, whereas in ETF, they have 509, such as VO, the ETF. You do not need to research at all. Put your money in the ETF, then 20 years later, your money will grow. So whereas if you leave your money in 30 individual stocks, you don't do any research, some stocks may go down on news if you don't research, and then you lose all your money. The last negative is that individual stocks could cause you to be emotional. This is because like some stocks, if they go down, you lose your money. So that could mean you get sad and you just give up and you sell the stock. You panic and sell the stock, which that is not good. You'll be much better off investing in ETF. So when that goes down, you don't lose your money because that one specific stock is not weighted 100%. So you put $1,000 in this, 1,000 of this at this around $74.19. Then by now you would have lost 71% of your money. So if you put it in VOO, instead of losing all your money, you would have gained 17%, which is better than a 71% loss. The first pro is that you do not have to pay any expense ratio fee because you manage your own portfolio by yourself, because expense ratios can add up, which could cost you a lot. So let's say there is a 0.03% expense ratio. So if you invest $1,000, that will be 30 cents per 1,000. So that's the expense ratio fee for ETFs, for that ETF. So that is not much for 1 year, but across many years that could add up to $100, $200. Another pro of individual stocks is that it is high risk, high reward. $1,000 around January last year, you would have made 80% of your money back. So that'll be quite a lot. The next pro of individual stocks is because you get to pick your own stocks. So this might not be a pro, but with me, I don't like when ETFs have stocks I don't like. So my final verdict for this whole topic is that if you don't want to take a risk and you want to eliminate losses and you don't want to do research, you just want to let your money grow, then go with ETFs. They are quite safe. If you want to take that increased risk and more reward, check on your stocks at least every week, catch off the news, buy and sell actively, buy at the lows, sell at the highs, then an individual stocks would be for you. Go for individual stock. But for my opinion, if you're just starting out, I would suggest ETFs, and when you get more experience, go with individual stocks. So if this video helped you out, please don't hesitate to subscribe to me and like this video for the YouTube algorithm, so my videos reach to a larger audience, which will help them to invest. Happy investing, everyone. Hope you guys have a wonderful day today, and see you next time in the next upload.